Healthcare is full of acronyms and alphabet soup. PPO, HMO, HDHP, EPO, EAP, and that's just to name a few. And if you're under 200 employees, you've probably been told you don't have any options, but that is not the full story. So let's decode the plan types available to small and mid-sized businesses. So first, I'd love to cover the traditional insurance plans that are available on the market today, the ones you might be most familiar with. The first is PPO, or Preferred Provider Organizations. These are flexible, larger networks, but they come with really high cost. The second you may have heard of is HMO, or Health Maintenance Organizations. These are lower cost, they have really tight networks, which means limited availability for employees, and they have primary care gatekeepers. And the third one that I know so many of you are familiar with is high deductible health plans, or HDHP. These have lower premiums, but they have really high out-of-pocket costs, and they're often paired with an HSA. So the next part I want to talk about is funding models. How do you actually pay for insurance? The first one, and probably the most common on the market today, is fully insured. This is where you pay a fixed premium and the carrier takes on the risk. This is the most common for small businesses today. Second is something called level funded. This is more like a hybrid option. You pay a set monthly rate, but can get refunds if claims are lower than expected. The third, which is usually reserved for much larger businesses, is something called self-funded. Basically, you pay the claims directly and the carrier just administers. It requires something called a TPA, or a third-party administrator. The employer basically becomes the insurance company. It's really rare for any companies under 300 employees, and typically reserved for companies with 1,000 employees or more. And the last one is a captive. This is where employers pool with other small employers to share risk. Now that we've covered the most common premiums on the traditional insurance market, and we've talked about the funding, I'm most excited to talk about recent advancements in the insurance space. The first one I'd like to talk about today is called ICHRA, ICHRA, and it stands for Individual Coverage HRA. And in ICHRA, you give employees tax-free money to buy their own ACA compliant plans, similar to like a 401k, and these pair really, really well with health shares. Second is something called a health share or co-op. By law, these are not insurance, but they absolutely pay for health expenses at a significant cost savings. You may not know this, but over 2 million Americans today are part of the health share model. The third is something called direct primary care. This is where you pay a flat monthly fee for unlimited primary care. This is often combined with catastrophic coverage like a health share. So now that we've talked about the premium types, the funding models, and some of the recent advances, the last thing I want to touch on today is tax advantage accounts. So the most common you've heard of is called an HSA, or a health savings account. These are only available when you have a high deductible health plan, no other plan. Employees and employers can contribute pre-tax dollars for medical expenses. These funds roll over year to year and belong to the employee. So they're a really great option for high deductible health plans. And the other ones you may have heard of is called an FSA, or a flexible spending account. These are also pre-tax dollars set aside for healthcare expenses. It's employer sponsored, but it's use it or lose it each year. It provides upfront tax savings for employees, but less flexible than HSAs because they do not roll over. So what do we do with all this? What we recommend is find an advisor and a plan that gives you access to the most options for your business and for your employees.